All right, why don't we go ahead and get started? So thank you guys for joining. I'm Mark LaMonica. I look after the individual investor team here in Australia for Morningstar. Today we're going to talk about a popular topic, income investing. Before we get into that, a couple of things. Number one, anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. Also, if you're over in New Zealand, get a copy of our FAP on our website, morningstar.com.au. And also the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you would like personal advice. Try not to get in trouble with the peanut gallery over there. So we have Shani and also Emily. Emily doesn't talk during the things like Shani, but all right. More respect. Yeah. Well, that's not hard. Okay. We're going to talk about income today. And this guy, shirtless guy with a watch on, is Jimmy Buffett. So that's Jimmy Buffett. I just put a quote that I like about him. But why am I talking about income today? Because this is what everyone's dream is, that they create a portfolio. The portfolio generates passive income. That passive income allows you to go do whatever you want. So if you're Jimmy Buffett, you go to the beach or go sailing. But that is a dream, right? Replacing the hours that you go to work with whatever you want to do, just being supported by your portfolio. So we'll talk a little bit about income today and some different things you should look out for. So say goodbye to Jimmy Buffett, another star. This is a star-filled webinar today. So that's, of course, Tina Turner. So there is no alternative is something that has been around for a little while now, but as interest rates have gone down, a lot of investors have turned to income from shares. And that's what we're going to talk about today. First, let's go through some different categories and different places you can get income. All right. So domestic shares, Aussie shares. What are the advantages? More predictability than ETF and funds. We'll get into that in a second. That says FUDs, not funds. That should say funds. Clearly, I spent more time finding pictures of celebrities than proofreading this. We'll talk about why ETFs and funds can sometimes not be good choices for income. Franking credits. We'll spend some time talking about franking credits, but franking credits, of course, add to the income you get if you are living in Australia and are investing in Australian shares. So what are some of the disadvantages? So with Aussie shares, it is more difficult to diversify your income, of course, because if you're buying individual shares, so we're talking about individual shares there, you need to buy a number of different shares in order to diversify that income, where obviously an ETF or fund is a single transaction. There are certainly concentrations in Australia. So I think anyone who follows the Australian market knows that resource shares and financial shares make up a very big part of a market cap weighted ASX, any of the ASX indexes. And market cap, of course, refers to how large a company is, and a market cap weighted index means bigger companies make up more of the index than smaller companies. So one of the problems you have in Australia is, yes, there is a lot of concentration. And when we talk about, and we'll talk about this a little bit later, when we talk about diversifying your income, you want to make sure that you are not too concentrated in a single security if you're buying individual shares, but also in a single sector as well, right? If we think about financials, yes, there are differences, obviously, between Westpac and CBA, ANZ, et cetera, but they're still influenced, being in the same business, they're still influenced by similar things that happen in the economy, interest rate levels, et cetera. So you do want to diversify. That's harder in Australia. A lot of the Australian companies as well, so something else around investing in Australian companies, is a lot of the companies here are much more domestically focused than you get in other countries, meaning a lot more of the revenue they make comes from Australia than if you go and invest in US companies, which tend to be more global, and certainly European companies that tend to be more global. Global shares, once again, we'll get into this predictability around ETFs and FUDs. You do have the ability to diversify, once again, into a wider variety of sectors and countries. So investing internationally for dividends does make sense in some certain ways. There are some issues, though. Number one, franking credits. which I hear from people all the time that they would not invest overseas because there are no franking credits. There are some advantages. Once again, you're buying individual shares here, so it's more difficult to diversify. And in general, you have lower yields than domestic shares. Now, we'll talk about that a little bit later on, but because of franking credits, and for anyone who is tuned into the webinar on Tuesday, because of franking credits, because of the desire of a lot of Australian investors to get dividend income, companies, of course, do what shareholders want. So you have higher payout rates in Australia and lower growth, which we'll talk about. But payout rate just refers to earnings. More of earnings are paid out in dividends. So something. Oh, Charlie's sending me messages now. I don't even know what that one means. The other issue you have with global shares, which we'll talk about, is currency. So just like investing globally, you need to worry about currency and how currency movements are going to impact your returns. You also need to worry about that with income. So obviously, well, not obviously, if you are an Australian investor investing overseas, you want the Aussie dollar to go down. So same thing with income. The Aussie dollar goes down, that dividend payment that's made by a company in the US or Europe is going to be worth more for you when you translate it back into Aussie dollars. So if the Australian dollar goes up, even if the dividend stays the same or is increasing, that is going to lower your income. So something to think about there. All right, so let's talk about ETFs and funds. See, I wrote funds there. So, I'm not a complete idiot. Many people do turn to ETFs and funds, probably mostly ETFs as individual investors, but many people do turn to them in order to get income. There are certainly ETFs that are specifically marketed as income ETFs. And the advantage, of course, is it's easy to diversify, right? A single transaction into ETF, and you can own hundreds or thousands of companies. One of the problems with ETFs that I think people run into is that the distribution, and I'm using that word deliberately, not dividend, the distribution that comes out of an ETF is not just income. So an ETF or a fund is just a pass-through vehicle, right? So they are passing through any income earned by securities that are held in that ETF or fund, any income and any capital gains that are generated. So when you get that distribution, it's not just income, but most people think it's income. So the problem that people run into is they will sit there, they'll buy an ETF because it has a very high distribution, and then realize that that distribution isn't just income, and the next year it's a lot lower. And there is less predictability because you don't know what capital gains are going to be generated. And I'll talk through a couple of examples, but you don't know what capital gains are going to be generated. And predictability of income is something that a lot of people desire, right? If we want to go back and be Jimmy Buffett and hang out shirtless and shoeless, but with our watch on, we would like predictable income. And you're not going to get that. So you're going to get more fluctuations with ETFs and funds. So something to think about there. So hybrids. So people do turn to hybrids. Hybrids are basically securities that have characteristics of both equities and fixed interest. So they're often issued by banks. So there's some reasons around the capital the banks need to hold and the regulations around that make it desirable for them to issue hybrids. So generally with hybrids, you get higher income than fixed interest, and there's lower volatility in the shares than you get with equities. You do get franking credits, everyone's favorite thing. But you should realize that they are higher risk than just buying a bond. And then we've got bonds at the bottom, fixed interest. So a lot of predictability around income. Right now is not a great time to buy bonds. So you're getting very, very low interest rate. So this is the different places you can go to get income. But basically back to our friend over here, Tina Turner, a lot of people are turning to shares right now for dividend income, given where we are with yields. One thing I would note is that dividend yields, which how you measure how much you're going to get out of a share, are also historically low because the market has gone up so much. So not a great place not a great place to look. All right. Let's talk about everyone's favorite, franking credits. So put this chart up. Our equity analysts put out a report probably, I don't know, 6 months ago, looking at dividends. And this was a chart in the report that I thought was helpful. So what this chart is showing, sorry, 1 second. What this chart is showing is it is showing the ASX 200, then it is showing the ASX 200 when we include dividends in it, and then it's showing the ASX 200 when we also include franking credits. So one thing to note is that in almost any index, anywhere you're looking around the world, dividends are a large part of total returns if you go back historically. So they are important. But you can see here, the return of the ASX, looking back a decade from when this report was released in June 2021, ASX returned around 5% if we're just looking at price returns, 5% a year. Then if we start adding dividends, we get up to 9% a year. Then when we layer on franking credits, and you almost never see this return. So oftentimes you'll see a total return, which will include dividends, but when you layer franking credits on there, then we're up to 11% a year. So basically what the value that franking credits have provided, and once again, everyone's different from tax situations, but still about the value that franking credits, according to our equity analysts, are about 2% a year. So something to think about. So I know people do like franking credits a lot, but it was good, I think, that our equity analysts went back and actually quantified that a little bit. All right. Oh, no. Oh. Do you still see this? Yeah. Okay, so this is a ridiculous picture that Shawnee put together, so I apologize for that. That is me with a bottle of Passion Pop, so I can confirm that that was not superimposed, but still. Anyway, let's talk about dividend reinvestment plans, and we're going to spend a little time thinking about how you can build up income in your portfolio. So assuming you're not at the place where you're living off of passive income, how can you grow the income that your portfolio has? So one way, of course, that you can do that is you can just invest more, all right? So obviously contributions you make into your account will allow you to buy more shares, more ETFs, more funds, whatever, and build up that income that you're making. Another way that you can do that pretty effectively is using a DRIP, or a dividend reinvestment plan. So basically what a dividend reinvestment plan is simply, instead of taking cash for your shares, and some are done by companies, some are done within your broker, instead of taking cash dividends, it would just be reinvested automatically into more shares. What this allows you to do is it allows you to compound your income growth even more. So we've got this little example that Shawnee made up called Mark's Bourbon Company. That would be a very bad company because I would literally drink all the profits. But what we have here is if you buy 100 shares for $1 in Mark's Bourbon Company, you're spending $100, it's yielding 5%. So what happens in a year? Now we're assuming the share price isn't moving at all here, but what happens in a year? Well, all of a sudden, if you're taking, instead of the cash dividend, if you are taking shares, you have 5% more shares. So remember, that's the assumption that the share price isn't moving. So you have 105 shares. And what this has basically done is it is effectively lowered your cost base. So this is not tax advice. You're going to have different parcels and everything else for taxes, but it's not tax advice. But what it's effectively done is it has lowered that cost base, because now you have you have $105 worth of shares, or you have 105 shares instead of 100 shares. So by effectively lowering your cost base, that is making the yield on your original investment go up. So it's a way that we can compound income. And if you look over years and years and years, it's quite effective. So I'll use an example in a second, or I'll go through an example in a second. So Stephen said, yeah, not sure the cost base is diluted. The cost base is not actually diluted, but in practical terms, it has been lowered, right? So you have 105 shares that you paid $100 for. So this is a way of thinking about it. This is not tax and how tax works, but it's a way of thinking about it. So I should have been more clear with that. All right, so let's use a real example because real examples are good. So we're going to look at Transurban. So Transurban, of course, is a company that owns toll roads. So people that commute and pay tolls, some of you in Sydney and Melbourne and Brisbane are paying it to Transurban. So Transurban started trading. So this assumes that you participated in the IPO of Transurban in 2009. And we're assuming that you are making initial investment. You're buying 1,000 shares, spending $5,000. So we have two different scenarios on here. We have right here, we just see the dividends that were paid. So we're just going back and looking at the dividend history. Now, I deliberately picked a company, and things did go downhill a little bit in 2020 because people weren't driving. In terms of the dividend, I deliberately picked a company that did have pretty steady dividend growth over the years. So we've got two different options. The first option is you take your dividends in cash. So every year you can see that the amount that you are making off of your investment of 1,000 shares is growing. And it's growing because in this case, the dividend is growing. And that's another very good thing about investing in shares rather than fixed interest. If it goes well, if you pick the right company, is that dividends tend to rise over time. We'll sort of talk about why that happens, but companies are becoming more profitable. They are paying more of those profits out to you as the owner of the company. So in this case, pretty good, right? So over this time period, you earned $3,225. The other option, as we said, is you can invest in new shares. So what I did is I went back, I looked at all the dividend payment dates here and looked at how many shares you could buy. So all of a sudden, instead of 1,000 shares, you are up to 1,500 shares. So we are seeing more growth. So what does this mean if you are a shareholder? So if you were in the first situation, because of the share price growth as well, so this is taking dividends in cash, at the end of this period in 2017, you would have increased from $5,020 to $11,650. Which is nice. You would have obviously grown your income pretty significantly. You're making $545 a year instead of $230. In the second scenario, where you are reinvesting the dividends, we get to see how that compounding actually gets added. So the compounding not only of the dividend growth, but the compounding of the number of shares you have as well, which is just accelerating that. So at the end of the period, instead of $5,020, you have $17,861, which is, of course, very good. And you can see your income significantly higher as well, $807 versus $514. So it's just a real life example of how when you're investing for income, if you're trying to build that passive portion of your portfolio, one pretty effective way to do that is to reinvest your dividends. So that means, of course, you're not earning income over that time period. But if you're sort of shooting for a goal where you're trying to get passive income to pay for something in your life, then it can help accelerate that. All right. Now, everyone likes to talk about franking credits. And franking credits, as I said before, of course, are influencing Australian companies and how much they pay out. So we've got this chart going back to when franking credits were introduced in Australia. So what is that? 1989. I can still read. I'm not that old, although that's a small graph. And then when franking credit cash refunds, which obviously I know have a little bit of controversy with certain people, started getting paid. And what you can see between these two lines is we've got Australia and the US. Australia is this top line. I'm colorblind, so I assume that's a color and a different color, or this would be a very confusing chart. So imagine what my life is like. So this top line is Australia, bottom line is the US. What you can see is after the franking credit, cash refunds, there's been a pretty big divergence in the payout rate. So let's talk about what the payout rate is. So a company, and we'll talk about this in a second also when looking for sustainable income, a company, of course, can pay out when they make earnings. They can make all sorts of decisions with those earnings. So a company can reinvest it back in the company. They can try to grow the company, right, by hiring new people or building a new factory, obviously depending upon what the company does. They can go out and acquire other companies. So they can go make an acquisition. They can pay down debt. They can pay everyone more, buy a corporate jet. They can make all sorts of different decisions. One of the decisions, of course, they can make is paying a dividend. So as dividend investors, we look at the payout rate. We look at what percentage of earnings are being paid out to see how sustainable that dividend is. Now, there are some exceptions to this, particularly in industries that have very high depreciation expenses. But in general, you can't pay out more than you earn for an extended period of time or you run out of money. Now, I'll talk about the exceptions in a second, but the payout rate then tells us how sustainable dividend is, because it basically means how much can earnings fall before that payout rate exceeds, or before what's getting paid out in a dividend exceeds what the company's actually earning, right? So if you have a 97% payout rate, that means 97% of your earnings are being paid in dividends, and means if your earnings fall 5% the next year, you are no longer covering your dividend. That could be an indication that the dividend would be cut. So payout rate basically are decisions. It's a decision by a company that they are going to allocate a certain amount of the money that they have to dividends rather than all the other things that I listed. So we can see in Australia, the payout rate is significantly higher than it is in the US. And one of the reasons is there is a lot more investor preference for dividends. But one thing to think about is, of course, why do companies reinvest in themselves? They reinvest to grow. As a shareholder over time, that's very good. If the company is growing, the more you pay out to shareholders, the less you can invest in the business, and potentially the slower the growth can be. So companies are obviously trying to find that sweet spot, and a dividend can keep a company honest and make sure that they are setting standards on investments, whether that's a private jet, which isn't much of an investment for their executives, or investing in the company, that they are only investing in their best opportunities. But also it can sort of starve a company of capital, right, if they're continuing to pay out all their earnings or dividends. And if we do go back and we look at the last 10 years, so CAGR is compound annual growth rate. So the S&P 500, close to 14%. So these figures are about 6 months old. ASX 200, around 11%, even including franking credits. So what does this mean? It means if you would have invested in the US, even with franking credits, you would have made more money. Now, this, of course, is historical, so it matters not at all going forward, but it is just important. And we had a question about this the other day, to look at total return as well. The other thing is that you want the dividend to grow. So this is the problem we have as dividend investors, that the more that's invested in the company of the capital they earn, the faster they can potentially grow. If they are not investing in the company, they're not going to grow as fast. If they grow fast, they can raise a dividend in the future. So if we look at the ASX average dividends per share, last 10 years, this is from around July of last year, dividend grew 3.4%. You can see the S&P 500 in the US grew significantly more. So those are the trade-offs we're making as investors between whether we are looking for a high yield right now or we're looking for growth in the future. So I was looking at two particular countries here, but you can make the same assessment by looking at companies. You can find a company that maybe has a higher dividend right now very high payout rate versus a company that has a significantly lower dividend, but is growing faster and can raise that dividend more in the future. And obviously there's a sweet spot there, but it is something to think about. And I think if you're building a diversified portfolio with the aim of generating passive income, that you probably want to invest in both, is probably helpful. All right, let's talk a little bit about sustainability, and then keep the questions coming. I will get to the questions. So, all right. Why do we care about sustainability? Well, of course, we care about sustainability of a dividend because a dividend is not an obligation. It is a choice. It is a choice that a company makes, usually in Australia, twice a year. 2 dividends a year, usually in the US and Europe, similar to Australia, usually in the US 4 times a year. But every time a dividend is declared, that is a choice by a company to do that. So 1, it's just, does management want to do that? And number 2, can they do that? So when we focus on dividend sustainability, we want to make sure that whatever we purchase, if we went and purchased a share because we want to earn income off of it, that it has the ability to continue to pay that income. And what happens a lot with income investors is they think, okay, well, income's what I'm trying to get, so I will just simply go and look at the shares that pay the highest dividends and I'll just buy them. But just remember that the dividend yield, which is how we measure that, is impacted by the dividend level, but also the price. So oftentimes companies that are doing really poorly and the price goes down of their shares significantly, the dividend yield, of course, goes up. But the dividend yield is based on past dividends paid. So this could also be the market signaling that risk has gone up in the company and that potentially that dividend yield is not sustainable. So just be careful about that. And I will say, especially when you're investing in Australia, Australian companies with higher payout rates, there also tends to be more volatility in those dividends. Whereas in the US, companies basically will not cut a dividend unless they are really, really forced to, because the mentality is that a dividend needs to be maintained and investors really punish the stock if there's a dividend cut. And I'm not saying they don't in Australia, but there is just a little bit of a different mentality there. All right. So what are some ways you can judge the sustainability of the dividend? So the first thing you can look at is, of course, the company. Is this a strong company? And the Morningstar Economic Moat Rating, so that is our analyst assessment of the sustainable competitive advantage of a company, which means the company is able to protect profits and protect pricing from competitors. So very quick explanation, which I give a lot on these, is that competition is good for us as consumers. It is bad for companies and bad for us as investors, because competition leads to price wars. And if you're a company that you own, it's a great thing as a consumer. If companies are lowering prices, not so good if you own the company. So it tends to lead to price competition, and it tends to lead to a lot more investment, right? So I'm going to compete with you on price, or I'm going to compete with you by building a better product. And so if I'm constantly trying to build a better product and all my competitors are constantly trying to build a product, we're investing a lot in the company to do that. Neither of those things are good. So a moat or sustainable competitive advantage is holding those, the competitiveness of capitalism at bay because of something the company has. So if you look for companies with moats, they're more likely or more able to maintain those dividends because they're able to withstand competition. Revenue growth. So obviously we want companies that are continuing to grow because that protects the dividend and offers opportunities, of course, for it to grow. But if we think about payout rate, a percentage of earnings, well, if earnings are continually increasing, that payout rate's going to go down, all things being equal. The dividend isn't raised. Another thing to look for is customer concentration, right? So we are looking, just like we want to diversify our portfolios. If we are worried about income or perhaps any sort of investment, we want to look and see how many customers companies have, and how, if we look at the types of customers they have, do 1 or 2 customers make up a large percentage of their revenue? Because it just increases the risk, right? Whereas if you have millions of customers making up the same percentage of your revenue, it's a little easier place to be in, because if you lose some customers, it doesn't really matter. Recurring revenue is something that's really interesting. So we hear all the time, or maybe just I hear all the time, that people love businesses that have a subscription model. So basically, this idea of recurring revenue, as opposed to a company where every day they have to wake up and try to sell more products. So something to look at. Recurring revenue makes a company's job a little easier if these things just tick on, just like, I don't know, your Netflix, that you just pay it month after month because it hits your credit card, sort of this mindless thing for a lot of people. That's very good for the company, right? That's recurring revenue. Margin compression. So profit margins, as I said, are one of the things that get hit when there's a lot of competition. So profit margin is the difference between what you sell something for and what you keep as a company. And there's lots of different margins we can use, but that is it in the essence of it, at the very least. So if you're selling something and you're competing on price, and you have to lower your prices, that's generally going to lower your margin. If you have to invest a lot more in order to make a sale, that is going to compress your margin, and none of that is good, right? As a dividend holder. And, I think a good example is probably buy now, pay later space. I think at this point, everyone can pile in on them, but we did it early, right, Johnny? So one of the problems with Zip, and Zip has not done well, is they had to invest a ton in marketing and new client acquisition because there's so much competition in the industry. And so in their case, they never got profitable. But that's the type of competition we don't want. So margin compression can be a sign that potentially the dividend's in trouble. The payout ratio, we talked about this a lot. The lower that payout ratio is, the more protection you have if earnings were to go down. And also, the more upside that management could just make a decision, right? If you're paying out 50% of your profits and dividends, it's a little different than if you're paying out 90%. You have less wiggle room at 90%, whether your earnings come down or whether you want to try to raise it, you have a lot more at 50%. And then finally, financial strength. So we do want to look at the financial strength of companies. We want to look at the balance sheet. So there are 3 different financial statements that companies issue. The balance sheet is a snapshot in time. Look at all the assets and liabilities a company has. So a company has a ton of debt. They have less financial stability. That could be a sign that the dividend is at risk, because they have to service that debt and potentially are continuing to take on more debt. And there's all sorts of different ratios that you can look at to look at debt levels and how a company is doing. All right, we did it. Is everyone excited? So we've got a fair amount of questions. So why don't we go through those? Okay, so we got a question from Craig. So Craig says, any thoughts about private debt as a source of income? Okay, so not any direct thoughts, but let's talk about what private debt is. So debt, of course, is issued by companies when they issue bonds. They can also go to a bank and borrow from the bank. Private debt is simply non-publicly traded debt. So a lot of times you can purchase it through a fund company. So there could be fund companies that are financing companies. And then, you can go buy basically a fund that holds that private debt. People have been drawn to it because you can get a higher yield than you can get in public markets where you go out and buy a bond. So, Craig, I guess I would say it depends. It obviously depends upon what you're investing in. A lot of these are not that diversified. So I would look at the diversification. I would look at the fees. The fee levels are pretty high on a lot of these sort of private debt investments. But in theory, it is just the same thing as a bond. You have credit risk. Will the people that borrow the money pay it back? And you have a little bit of interest risk in there as well, interest rate risk as well. So I know a lot of people are using Craig. I haven't, but I've certainly explored it. All right, so Roddy's saying, presumably there's some equity ETFs and funds that are specifically focused on dividends income only, which would presumably aim to be more reliable. The problem, so it's a good question, Roddy. There are a couple things that I would say, like, it is not In terms of reliability, we're talking about not the dividends getting cut. We're talking about that capital gains can fluctuate. So it depends. Like one of the issues is, so what some of these ETFs that are based around income, some of them, what they do is instead of weighting the ETF based on market capitalization, so that would be what a normal index, so like the ASX 200, the bigger companies make up more of it. Some of these would fundamentally rate an index, and one of those things might be dividends. So in theory, this makes a lot of sense, right? That if I'm interested in dividends, I will allocate more of the index or ultimately the ETF into shares that pay higher dividends. The problem that you run into is that, this situation exasperates the situation that I was talking about earlier. So it involves a lot of rebalancing, right? So if I am allocating more money to shares that pay higher dividends, what does that mean? It means that if a share price goes up significantly and that yield goes down, I might reallocate into something with a higher yield. That act of reallocating creates a capital gain, which will then be distributed. So those are the problems that you run into with a lot of these ETFs. And the very famous one is, so it's not the sustainability of the ETF, it's just looking at the construction of the index that this thing is tracking. One of the really famous ones that I make fun of all the time because I think it's terrible is this FANG ETF that paid this really high, Shani's laughing at me, that paid this really, really high distribution last year. And I was looking at all these messaging boards and everyone was so excited because they got this huge dividend. Well, it wasn't a dividend, because if you go and you look at the underlying shares, and there's only 10 of them, so it doesn't take very long. If you go and look at them, only one of the 10 paid a dividend, and it was like practically nothing. The issue is that it's equal weighted between those 10 holdings in it. So they want an equal amount in each one of those 10 holdings, and they rebalance it quarterly. So because the market was going up, they were generating these huge capital gains that were getting passed off as distributions, and a bunch of ill-informed people thought that they had found this great dividend opportunity when they were buying shares that didn't pay a dividend. So it's that type of thing, that problem that you run into. Okay, so Phil has a very good point, and one that I've been thinking about a lot, Phil. So Phil says compounding using dividend reinvestment plans is a wonderful thing, but you have the choice of taking the dividend as cash, then you can invest it in another stock, which you think is a better investment, or take it as income. Yes, so absolutely. So what Phil is saying is taking a cash dividend gives you that choice. And if you are years away from when you want to start using this money, you can just simply take that cash and invest it in a better opportunity. That assumes that you can find the better opportunity. So the only thing I would say from like a behavioral standpoint is, what a dividend reinvestment plan does for you sort of takes that buying decision out of your hands and automates it. So presumably, if your portfolio holds companies that you think are pretty good, then what it's doing is of course reinvesting those dividends, whether the company's gone up a lot in price and potentially isn't something you would invest in or not. So I get the point, but it does take that out of your hands, and sometimes that's not a bad thing. But yeah, Phil is right. As long as you can continue to identify good opportunities, taking it in cash is better. You just have to be able to do that. As long as you pick the right company. So Joy says, as long as you pick the right company and not Freedom Foods or many others, crystal ball gazing to some extent. Yes, I agree. Obviously, the problem with buying individual companies is you need to buy the right individual companies. All right, so the anonymous attendee, our favorite attendee, is asking, what should you look for in a fund liquor ETF if interested in income? Okay, so I would look at a couple different things. I would, number one, look at how they are identifying, right? Anytime that you are, so we'll talk about both sides of these. So number one, there's passive. There are passive indexes. And these are, indexes that have been put together, obviously, that's tracking an index. Go look at the the index construction methodology. So that's the first thing I would look at. A lot of ETFs, not a lot, some ETFs that have dividend or income, same thing with funds, in the title, don't actually really provide you with that much. So go make sure that it is actually focused on income, because some are focused on future income, which is great. Maybe that strategy works out really well, but you're not going to get a lot right now. It's looking for identifying companies that'll pay out a lot in the future. So the first thing I do is go look at that construction methodology, go look at what's actually held in those ETFs and look at the dividend yield. So like if you go onto our website and put in an ETF or a fund, you can look at the dividend yield of the holdings. Now that can be very different than what's actually getting distributed. That difference, of course, is capital gains. So I think that's a good thing to look for. In terms of a LIC, so LICs are very popular with income, as they should be. So while funds and ETFs are simply pass-through entities, capital gains, any income earned just get passed through to the end holder of that security. LICs are different. So LICs are an actual company, right? So the management of that company, even if it's just invested in a bunch of shares, gets to make a decision. So basically what a lot of LIC managers will do, knowing that people want income, is they will smooth out the income that's paid to people. So they have the ability to retain capital gains, to retain income, and pay it out in the future. So they will smooth that out. So like if you go back and look at 2020, where dividends were cut and suspended and everything else significantly, and income fell a lot, go compare ETFs to LICs during that period, and you'll see LICs did not go down as much because they had reserved capital gains or distributions that they could use to smooth out that income. So Sally is saying, thanks so much for the global Australian comparison. Very helpful. Our comparison includes the impact of franking. Yeah, I mean, I think it's important, and obviously we have no idea what's going to happen going forward. I will say from a valuation standpoint, the US market is a lot higher than Australian market. Our investment management team here thinks that returns in domestic Australian shares will be higher than global shares going forward, given that valuation gap. So remember, we're looking at the future, but yeah, if you do look in the past, excess returns that you got from investing in the US made it still a better investment, even though franking credits are included. All right, so we've got, oh, geez, you were getting busy. Yeah, so really good point by George. So George says, and I should have mentioned this, with a dividend reinvestment plan, and I've seen this a lot, that people don't realize this, you still have to pay taxes on that dividend. So it's a really good point, George, that a dividend, just because you're reinvesting that dividend in shares, does not mean that you are not paying taxes. So instead of taking the dividend, using a portion of that dividend you receive to pay taxes, you got to pay them from somewhere else. So that's a very important thing to remember. So yeah, good point. So we did have a question. Yeah, so Linda's saying, I think ETFs and managed funds are best held by people on low tax levels, as they're not slugged with massive capital gains tax bills they have to pay. Yeah, so remember that as well. Like, that distribution that you're getting in the ETF, yeah, you got to pay taxes on all of that, the capital gains and the dividends. Sorry, I'm just reading one thing. Okay, so we did have a question, and I'm sorry, I actually did not know the answer to this question by the anonymous attendee, but Shani looked it up for me. So she is not just creating funny pictures of me in Passion Pop. So we got a question from the anonymous attendee saying, recent changes in rules regarding issue of hybrids have excluded self-directed retail investors. Can you talk about this? Okay, so I will say that I did not know the answer to this. Shani said that a lot of bank issuers are being very conservative about their target markets. Their target markets for issuing hybrids, and this is locking out individual investors that do not have a high level of financial advice. So what it's basically saying is that you need an advisor to do that, or to be a wholesale investor to invest in some hybrids now. But Shani is saying that is issuance. So that is when a bank issues a new hybrid, but there are opportunities through the secondary market. So obviously once something is issued, then people are selling it and it's trading in the secondary market. So thank you, Shani. The anonymous attendee thanks you for answering that. All right, we made it, which is great. Lisa has a comment of alpaca fame. So she says, regarding private lending, bond prices are quite low at present, hard to sell, easy to buy at a discount. So thank you for that, Lisa. All right. We've done it, which is exciting. Anyway, thank you guys very much for joining. So next week we have, and we need to send out an email on this. We've got webinars on Tuesday, Thursday. On Tuesday evening, we have 2 on Tuesday. Tuesday evening, we're going to do a earnings review. Is next week the analyst one? No, forget I said that. In a couple of weeks, we're going to do one with our analysts. Anyway, thank you guys very much for joining. I appreciate it. You can email me at mark.lamonica1@morningstar.com if you have any questions or want that picture of Jimmy Buffett. Not the picture. No, not the picture of me with the bourbon bottle. Anyway, thank you guys.